Well, welcome everyone for our first workshop on entrepreneurial finance and innovation seminar for the fall. We're really excited to have an exciting paper and a hopefully great discussant here with us today, so it should be all great. Just to give everyone a quick heads up on logistics, so we typically do about 40 minutes for the talk, and then we'll have 15 minutes for Minmo today to discuss, and then we'll have some question time at the end. But if you do have questions throughout the seminar, we've got a bunch of co-authors here today, so actually go ahead and put any questions you have in the chat, and hopefully they will get to them. We'll interrupt if there's a really urgent question or something like that, but otherwise, hopefully, we'll get everyone's questions covered there. As a final note before we get started, it looks like a bunch of you have already done this, which is fantastic, but if you can, please turn on your camera so that it's a little more of an interactive experience for everyone. No worries if you are not able to. With that, we are excited to have Ayako here today. Go ahead and take it away.
Thank you, Melanie. Thank you for putting our paper on the WEFI seminar series. I'm excited to be the first speaker of the year. And as Melanie said, most of my co-authors, the Vikas Agarwal, Brad Barber, Si Chen, and Lauddin Hamid, are on the Zoom chat, and Hashini Shankar, who's a PhD student at London Business School, unfortunately is traveling today, but otherwise she will be here as well. So everybody can answer the questions on the chat according, in line with the seminar format. So let me get started. To motivate our paper, the first fact that I want to point out is the rise of non-traditional investors in private startups. So investments overall in US startups rose very sharply in the last decade. And this huge increase, both in terms of the absolute amount and as a percent of GDP, this is somewhat reminiscent of the year 2000 with the dot-com boom, with one big exception, and that is the surge of non-traditional investors. In year 2000, $100 billion, that record-breaking investments were almost all from pure VC funds. But in 2021, which is the last peak, according to PitchBook, about half of the $350 billion recorded in that year of the money poured into startups came from non-VC funds. And among them, mutual funds were very important players. VC-backed startups, as you know, have this complicated capital structures with payment priorities being different among investors and founders at exit. Almost all of the returns come from exit values since there's very few interim cash flows. And investors in particular own preferred stock with convertibility to common stock. Founders have claims on common stock and options. So mutual funds are now holding these preferred stock convertible to common in the private startups. That raises the question, do mutual funds value these complicated securities fairly? Whether or not they do that has more consequences for mutual funds than for VC funds. Reason one, mutual funds set values of these illiquid private securities daily, and that directly impact the net asset value of the fund and the fund returns. And two, mutual funds are open-ended, unlike VC funds, and therefore they are subject to runs like banks. So we examine these questions in this paper. First, how much is the value difference between the most senior security and the other junior securities? And by senior and junior, I use this word throughout the talk to mean the security that has the highest priority, and these are usually the most recent round of security, versus other preferred stock that has lesser preference and claims to the exit payoff. How much is the value difference for the kind of startups that mutual funds invest in? And this comes from a model, fair value, and the model is based on the option pricing framework. Now, having calculated this model fair value difference, we then ask, how do the reported value by mutual funds of the junior stakes that they are holding compare to the implied fair value of those junior stakes on the day of the senior security issuance? And we report pretty large misvaluation. And then in question 3 and 4, we ask, do family characteristics cross-sectionally affect these valuations? And do some significant events like startup-specific or market-wide conditions affect these valuations? And can we understand the source of this variation in the valuation? And this is what we find. First, the latest issue and the most senior security is on average worth 48% more per share than the junior securities held by mutual funds. And this is the model fair value difference. So this comes strictly from the capital structure of the firms. And 2, mutual funds, when they are reporting the value of their junior stakes, report values that's 43% higher than the model fair values of the securities. And since the senior security is 48% higher in value, this implies that mutual funds are reporting values for the junior stakes close to par with the senior securities, sometimes even exactly at the same price. 3, we find that the overvaluation by mutual funds is lower for experienced mutual fund families, and it's higher when they are purchasing the securities in secondary transactions. And last, we find that the overvaluations of junior stakes goes down after the startups experience down rounds. So overall, we think that the mutual funds appear to be overweighting the probability of successful exit outcomes, such as IPOs, where all the preferred convert to common equity and are valued equally exposed, and underrating the probability of a more negative low exit value scenarios where these security contract differences actually matter in the exit payoffs. Our paper relates to 2 strands of literature, one on the topic of mutual funds investments in private startups, and on the second, in terms of the methodologies of valuing multi-tier capital structure firms. We have an earlier paper published in a Review of Finance that belongs to the first strand of the literature. And I developed a methodology based on option pricing models to back up the implied value of the firm and the junior securities in my VC textbook. And then we use that in this paper. So relative to this literature, we contribute by anchoring the actual reported values by mutual funds vis-a-vis the model fair values to measure the misvaluation. We also test under what assumptions the mutual fund valuation can be right, and then we can assess whether those assumptions are reasonable or not. We examine cross-sectional and time series valuation in this misvaluation discrepancy. And we finally reconstruct aggregate industry level misvaluation. So now I'm going to talk a bit about the methodology. So there will be some jargons, but I will try to minimize that. So VCs mostly invest in convertible preferred stock, unlike angels who take common stock or some other securities that convert later. Why do VCs invest in convertible preferred stock? There are 2 main privileges over common stock. One is the liquidation preference, which they make them senior in claims when liquidation events happen. So when the company is sold, merged, or shut down, they have a preference over common, and the preference amount is typically what they paid in aggregate purchase price. They also have dividend preference over common. So to think about what that means in terms of the present value of the securities, I'm going to use exit diagram to illustrate the exit payoff. So this is a diagram that plots the value of the security exit payoff on the y-axis on the exit date against the value of the whole firm, again at the exit date. So exit value of the whole firm and the exit payoff value of a particular security. So if you have a 30% stock on a all equity financed firm, your exit diagram is a 30% straight line from the origin. So let's first think about Series A with just the founders and Series A VC investor. Suppose VC invests $5 million in Series A, and it's structured as convertible preferred with $5 million, and it's 5 million shares of convertible preferred, and founders have 5 million shares of common. So in terms of common stock equivalent ownership, it's 50-50. But if you plot the exit diagram, you will have two different plots. The one in blue is for the Series A, and one in black is for the founders. Let's say that this firm is sold for $5 million 1 year later. Series A, because of the preference, will get $5 million. Founders get $0. If the value at exit for the firm is $7 million, again, Series A gets $5 million, and now founders get $2 million. At $10 million and higher for the whole firm, now each receives 50% of the firm value. And at $10 million mark, Series A investors would choose to convert, and then they will be treated equally beyond that. So from here, you can see that the present value of the common stock will be lower than the present value of the Series A preferred stock as of the Series A investment date. And it will be a function of what's the probability of this company exiting above 10 million versus below 10 million. So this probability is important, and I'm going to put a pin on that because we are going to come back to this after we show the mutual fund results. So we now can see there's a difference in present value. To numerically evaluate this, we'll introduce option pricing model. Now, slightly different stake by the founders here to illustrate why exit diagram lends itself to option pricing. Let's say the founders own 50% common stock, and Series A has, again, liquidation preference of 5 million plus 50% of common stock. Slightly different from the previous example, but just to make a point. If we plot the exit diagram of the common stockholder, you get exactly a diagram that looks like a call option. And you can see that for the first 5 million of the first firm exit value, the founders are out of the money. And beyond that, they get in the money only after $5 million. So you can think of this like a 50% of the call option with the firm's enterprise value with the strike price of $5 million. And we can think of expiration date of an option like an exit date for the firm with slight modification, which I'll introduce later. So introducing option pricing now allows us to translate this diagram to an equation. So going back to the first example of the Series A and the founders, now we can think of the Series A stake here as a linear combination of call options on the firm's enterprise value at exit. So again, now the x-axis is the value of the whole firm at exit. Y-axis is value of the Series A security payoff. And using the notation of C of X for call option with strike of X, we can now write Series A stake as call option with the strike of 0 minus call option with the strike of 5 plus 1/2 the call option with the strike of 10. And likewise, founder stake is call option with the strike of 5 minus 1/2 the call option with the strike of 10. So now we're getting close to evaluating these, and then we use Black-Scholes formula for European call option. So all the usual option inputs are now necessary. I guess the change is that instead of the usual per share price, we express everything, including the stock price today, in terms of the whole enterprise value. Otherwise, strike price, time to expiration, risk-free rate, and volatility as usual. We assume no cash dividends, allowing us to use European call option, and it's very reasonable for cash-starved startups who don't pay cash dividends. And one important adjustment that needs to be made is the fact that we don't know when the exit happens. So instead of a fixed exit time, we allow the exit to be uncertain and arrives randomly, like a Poisson process, with the continuous probability of Q, with the Poisson process that implies the expected holding period is 1 over Q. So if the expected holding period is 3 years, it exits on average in 3 years, but it has an uncertainty around it. Okay, so now we can look at some examples. If we assume the value of the firm is 10 million and have an expected holding period of 5 years and volatility of 90%, risk-free rate of 3%, but evaluating these 3 linear combination call options, the present value of the Series A stake is $5.6 million. Whereas the present value of the founder's stake is $4.4 million. They add up to exactly 10 million, as they should. And now on a per share basis, if we divide this by the 5 million shares each, Series A stock, preferred stock is worth $1.12, and versus founder's common stock is worth 88 cents per dollar. So preferred stock is worth 27% more than the common stock. To do what we want to do, we need to add one more structure, which is getting the implied fair value. So to do this, we use the most recent transaction price, let's say Series A price. Since this transaction price is actually observed, we assume that's a fair transaction, and on that day the fair transaction took place, we can back out what's the value of the whole firm implied, and what's the fair value of the junior stakes implied by the fact that that transaction happened on that day at a fair price. So instead of assuming that the firm is worth $10 million, now we find the value of the firm that makes Series A transaction fair or 0 NPV. So remember that this was the exit equation. Now we equate this to the price they paid, which is $5 million to invest in it. So if we equate this equation to $5 million and find the value of the enterprise value, so that once we plug in the option pricing formula, this equation holds, that turns out to be $8.75 million. So by definition, if the whole firm is implied to be worth 8.75, that means A's stake is 5 million, which is what the VC paid for it. And now we can back out what is the value of the founder's stake. And the founder's stake turns out to be 3.75, or 8.75 minus 5. Okay, again, dividing by 5 million shares to get the per share comparison. Now we are talking about 75 cents for the fair value of the common stock relative to $1 a share that Series A paid. So now we can say Series A's preferred stock is worth 33% more than the common stock. So the key to this whole thing is using the most recent transaction price paid by the investors to back out the fair value of other private illiquid securities in the startup's capital structure, including those private illiquid securities that mutual funds are holding in their portfolio. So that's the model framework. One thing I want to mention about the additional features of the VC contracts is VC often has other privilege like participation. And that means the payoff for the VC is always higher than common unless IPO happens. So IPO is something special. When IPO happens, contractually, all VCs are forced to convert to common. So in the event of an IPO here, all Series A and founders have exactly the same value per share. So that's important when we think about what are mutual funds thinking. Are they thinking their shares are ending up in IPO or their shares are ending up in a sale or merger? So we're going to come back to that. So far, the example that I described is between Series A and founders, but we can easily add more rounds, Series B, Series C, and do exactly the same thing analogously. And we find that on average, typically later series has more per share value than earlier series, because Series A has lesser preference and their liquidation preference value per share is lower. Baseline assumptions of Black-Scholes is all set at the value that's pretty reasonable. Volatility we use as a baseline is 90% using JFE paper by Cochrane. We do think it's actually an overestimate because most of our sample startups are large, late-stage startups, so it should be lower. But we use this 90% nonetheless for baseline and check robustness. Now I want to shift gear and state a hypothesis. So we have 6 hypotheses in total. First, in terms of the model fair value between senior and junior, just given what we know about VC contracts that usually award more value per share to the senior securities to entice them to invest in the startups, we hypothesize that junior securities like Series E versus Series H, that's going to be worth significantly less than the latest issue security on a per share basis. This is purely implied value from the model. So it's coming just from the capital structure and the contract set by the startups and the VCs. So the deal price is the senior security deal price relative to the fair value of the junior security on the senior security issue date. That -1, this is going to be positive. Hypothesis 2, this is now comparing the implied fair value of the junior security to the same security held by mutual fund and what the mutual funds are reporting it to be in their quarterly statements. So the price in the numerator here is the reported value by mutual funds of a security divided by our model's fair value of the same security, both evaluated on the date of the senior security. And if the mutual funds are exactly fair and using our model, this should be 0. On the other hand, our sample period from 2010 to 2018 is during a period of unprecedented tech sector boom. So some funds may be holding a very high expectations that all firms would have a successful exits and low negative exit probability. So as long as some fund families are doing that, we expect the mutual funds valuation to be in excess of model fair values. Okay. Now we want to understand what are the sources of this mass misvaluation, and are some fund families different from the others? So we hypothesize that the fund families with longer investment experience, on average, will be better, will be closer to the model fair values, and differentiate the value differences between senior and junior securities. We also think about the information cost and information access of the mutual fund families. Our paper, number 1, look at this issue, although not about the valuation itself. And we find that the fund families with better information access or information cost have overall better practice. So we look at whether those families are also valuing the securities more fairly. Number 4, fund families buy these securities either by participating in the VC rounds themselves or by purchasing the securities in the secondary transactions. And one thing we do know is that the fund families who buy in the secondary transactions, they don't get any information directly given from the issuing startups, whereas the ones who purchase in the primary transactions, and particularly bigger participants, do get more information rights. So from that, we hypothesize that the startups who buy in the secondary transactions may be less informed, and therefore they have a higher valuation of the secondary, more optimistic about the value of the secondary securities they buy in the secondary transactions, both when they purchase and in their subsequent reporting. I'm not looking at the chat, but so far all the chat questions have been dealt with. Okay, please stop me if I need to. Okay, in the hypothesis 5, we look at whether the fund families Bayesian update their valuation over time, especially in response to some experiences by the startup firms themselves. And in particular, how they update the relative probabilities of successful versus negative exit outcomes after they experience some salient events. So one salient event we had in mind is the down round. When startups experience a down round in which the valuation of the firm decline, that may increase the probability of negative exit outcome and decrease the probability of successful exit outcome in the view of the mutual funds. Also, down rounds often trigger conversion ratio adjustments if there is an anti-dilution clause in the contract. And that means that once the conversion ratio adjusts for the preferred stock, even in the event of IPO, when all convert to common, they would convert to different numbers of common shares and therefore expose their value, exit payoff value would no longer be the same across everybody. So for both of these reasons, we hypothesize that the fund family value of the junior stakes get closer to the model fair value after a down round. And especially so if the down value results in a conversion ratio adjustment. And finally, we check whether mutual funds exposed may or may not be correct in what they're thinking. So does the exposed performance of the mutual fund investments match their sort of inferred expectations of successful exits? So far, we find results that they seem to be really bullish. Well, are they actually correct exposed? So we look at fund families whose portfolio companies go public within 12 months. So if they were on the cusp of the IPO, they think that, oh, we are going to be all common. Is that why their valuation is higher than the fair value model? Can that be justified exposed? Similarly, we look at firms who have negative events in the next 2 years, going bankrupt and so forth. Is that the anticipatory valuation that's making fund families more pessimistic when they have a negative event coming up? Turns out this does not drive our results at all. If anything, it's the opposite. Okay. All right, I should speed up. Our data comes from multiple sources. Just one data source that I want to highlight is something called Certificate of Incorporation. And this is a filing that the startups have to make with the state in which they are incorporated every time there is a new round. So they need to restate their CIO. This is a really major source of data. We extract information from these documents in excruciating, long, time-consuming details and match up with many other data sources to build a database. Took a very long time. Okay, so first, in fair value model value difference, we find that senior security is worth 48.5% more than junior security on average. These are for securities held by mutual funds. That difference rises to 63% when we include securities purchased in the secondary transactions. We think this happens both partly because mutual funds tend to buy much earlier round securities. Sometimes they might be sold by employees or early investors, and those early round securities early round securities tend to be worth much less in model fair values. So that explains why the secondary purchase fair value difference is much bigger. Now, to test if the model assumptions that we are using are reasonable or not, and if the assumptions can be driving the results, we do the following sensitivity analysis. And I think it's very important to have confidence in our model. So the exercise we do is the following. We look at the value difference between senior and junior. So the y-axis here is the ratio of the senior over junior. We hold everything constant except one model assumption at a time to see how much the model assumption has to change for the value gap to close. So if we were to do this using volatility, we have to assume 300% volatility. Seems too high to be realistic. If we are adjusting the expected holding period, that has to be more than 15 years, which just doesn't seem realistic for mutual funds anticipation. And what if mutual funds believe the firm is worth a lot more than the post-money valuation? Well, that overvaluation has to be more than 5 times the post-money valuation. So these seems to be completely unrealistic. So it's hard to say that the model assumptions are creating this value gap between senior and junior. So that gives us a lot of comfort. Using the baseline fair value models, model fair values, now we compare it to the mutual fund's own reported value and find that mutual funds report junior stakes at 43% higher than the model fair values. And since the fair value difference between senior and junior is 48%, essentially that means mutual funds is marking junior securities close to par with the senior security, not differentiating between senior and junior. This overvaluation is also much higher for the secondary purchasers than for the primary ones. There are 108 cases where mutual funds hold 2 senior and junior securities and report exactly the same price in the same time. They cannot both be fairly valued given their contract differences. So we do a counterfactual to back out. If one security price is right, what's the value of the implied firm? If the other security price is right, what's the implied value of the firm? And measure the absolute value difference. And that discrepancy on average is 37%. So this 37% is consistent with mutual funds making a pretty large valuation error when they report 2 different securities at the same price. Okay, moving on. We find that somewhat comforting result. Overvaluation is lower for fund families with longer private startup investment experience. So they get better over time. But information cost or access doesn't seem to explain the valuation errors. We do find very significant result that the secondary purchasers overvalue both when they purchase and when they report subsequently, the 1 quarter, 2 quarters, 3 quarters after, their overvaluation is significantly larger. We find that down round does adjust valuation significantly. So overvaluation is smaller after a down round. And when that down round involves down round adjustment in the conversion ratio, there's even additional correction, and overall the overvaluation basically disappears. We look to see if mutual funds actually are exiting their IPOs at near 100%. Because if they are, then maybe their optimism is justified. So we track 5-year exit outcomes of mutual fund investments and compare it to overall 5-year exit outcomes of Series C investments by VCs using the data I used for my textbook. And we find that mutual fund investments do have a higher IPO exit probability, 45% versus 14% for VC. However, overall, after 5 years, only 60% of mutual funds investments result in any exits, and 40% remain private and illiquid. This is exactly the same exit probabilities as overall VC investments. So this makes it difficult to justify mutual funds valuation practice ex post, because they are good, but not that good at predicting which firms go public. Now, finally, we check to see, is it the anticipatory valuation of companies on the cusp of going public that's driving our result? And we find, actually, no. If the company is on the cusp of going public within 12 months, overvaluation is actually smaller. And if the company is on the cusp of going down, there's really no difference in the mutual funds overvaluation. So this anticipatory valuation does not at all explain the overvaluation that we document. And here we aggregate all the mutual funds we have in our sample to see what the aggregate misvaluation in a given quarter. And we used 2 alternative methods using slightly different assumptions. And we find that, let's say using third quarter of 2018, mutual funds reported 7.1 billion in holdings. Note that this is in 2018. So by 2021, this will be a lot bigger. So reported value of 7.1 billion compares to our model fair value for the same stakes of 4.8 billion, or about 48% aggregate overvaluation. Now, what does it mean for the fund level valuation? Because still private startups is a small percentage of the overall mutual fund portfolio. So let's say that the true portfolio weight of the startups in their fund, let's say for $100 million mutual fund, is 5%. So the true value is $5 million and true portfolio weight is 5%. But they're reporting these illiquid securities is worth $7 million at a 40% markup. Once corrected, this means this $100 million mutual funds valuation, they will lose 2 million or 2%. So 2% loss on the overall fund portfolio value does represent a significant misvaluation, even for the whole fund. And that should be of concern to mutual fund investors and also policymakers. So a couple of things that we are doing, and I'll wrap up. I think I'm still okay on time because we started about 2 minutes after. So we initially collected this data up to 2018. we really think the more interesting period is the more recent period when the valuation started to come down. So we are currently updating the data up to 2022. Like the down rounds, another important, interesting salient event might be cancel IPOs. So we are gathering a larger data sample. We look at a small preliminary analysis, and we do find that the overvaluation disappears after canceled IPO, collecting a larger data sample. And finally, startups are subject to 4.9 regulation to make a fair value assessment of the common stock in order to issue employee stock options. So it would be interesting if we can see if the companies are valuing 4.9A using one perspective, and on the other hand, VCs are investing in the same company, or the mutual funds rather, but then reporting very different valuation. So we're trying to have conversation with practitioners to get some data if possible. And this relates to Minmo's work, so I'm also talking to Minmo about this. So to conclude, we find so far that the senior preferred is worth 48% more than the junior preferred. Yet the mutual funds report junior stakes 43% above the model fair value. So that means they're valuing junior security close to par with the senior. This overvaluation is lower for more experienced fund families, but higher for funds buying in the secondary transactions. Overvaluation goes down after down rounds. So putting all this together, we think that mutual funds overweight the probability of successful exits, where everything converts to common, and downplay the probability of more negative or lower value exits, where the liquidation preference actually bites. And one recommendation to policymakers that we would make is to make it more difficult for mutual funds to not differentiate, or require mutual funds to differentiate the reported values between senior and junior securities. That's it. Thank you very much for your time. And now I'm looking forward to Minmo's and everybody's comments. Thank you.
Wonderful. Minmo, take it away whenever you're ready.
Thank you. You see my slides?
Yeah.
Okay, yeah. Thank you for inviting me to discuss this paper. And this discussion feels special to me because just until a few months ago, I was a grad student, and then I got tremendous benefit from the WEFI, the workshop, and then all the lecture series. And then I watched all of them. So if there are any students over there in the audience, then I highly, highly recommend that you do the same. Okay, so this is how I understand the paper based on specific example that Fidelity invests in Dropbox. So Dropbox was founded in 2007, and then they went public in 2018, IPO. And then nowadays, for sure, Fidelity owns a fair number of shares of Dropbox. And if you ask how Fidelity should value these Dropbox shares, I mean, that's not a hard question, because the Dropbox is right now publicly traded, and then their share price is, at the time of when I was making these slides, was $26.72. So it is an easy question. However, this thing isn't that obvious if you take a look at what happened when Dropbox, before they went public. So Dropbox raised money from a series of funding rounds. And in particular, they did Series B round in 2011 and Series C round in 2014. And Fidelity, the mutual fund, invested in both Series B and Series C funding rounds. And then how to value these Series B and Series C shares? This is not a trivial question, at least based on two reasons. First one is there is no centralized stock market, which is the public market. So there's no readily available data to mark to market. And also the bigger problem here is that the Series B has different features compared to Series C. So it is not, they shouldn't value these two share classes in the same price. So the paper has two key findings, or they ask two interesting questions, and they find two interesting patterns, which is, number one is that when Fidelity invested in Series C stakes of Dropbox in 2014, Fidelity overvaluates the Series B stakes they already acquired in 2011's Series B funding round. So that is one key finding. And then the second finding, or the second question that the authors are asking, is what predicts or what determines this overvaluation? So I just want to start from the measurement, or this how to know that these value the Fidelity is overvaluing stake B shares at the time of the stake C investment. So this is the first contribution, and in order to do that, the authors have to know two prices. One is the reported prices by Fidelity, for sure, and then the second is the fair values of these junior stakes based on certain models. So in order to do that, the paper did 3 steps. First one is finding mutual funds holdings of VC-backed companies and their reported prices. And then number 2, as Ayako showed, the authors identified contractual terms based on certificate of incorporation. And I work on this data for my job market paper, and I can tell that this step is not trivial. If you were to ask me to do it from scratch, it's going to take weeks and weeks, if not months, or not years. So, and then the authors used the option pricing based models that Ayako developed in her textbook with Andrew Metrick, and they use this model to measure what is the overvaluation or what is the fair value, so that they can compare to that overvaluation. And I wanted to also mention that there's nothing to quibble about how their models work or what kind of parameters they are using, because as Ayako showed, they did it really conservatively. And then no matter what tweaks you do, there's going to be a slight change in the point estimate, but the key message would be the same. Okay, as I said, convincingly and really thoroughly done. And I wanted to give one small suggestion here, which is based on going back to the Fidelity's Dropbox investment example. So this DEV PRC, maybe deviation percentage, is comparing the reported price to the fair price. So think about the Series B and Series C case here. So Series C happened in 2014, and the Series C price was $19.10, but this price isn't relevant for this particular key variable, but still, I wanted to point out that this happened at the time of the Series C funding round. And the Series B's reported price by Fidelity was measured by this price FB, Series B at the time of Series C funding round, which the authors figured out from the data, which is $18.46. And then Series B fair price, which is based on the COI, Certificate of Incorporation data, and their option pricing models, is $12.86, which is the fair value of security B at the time of the security C funding round. So if you plug in these numbers, they found that on average, 43.5% overvaluation of junior stakes, which is huge. So my one small suggestion here is that I want the authors to standardize this measure based on the distance between the funding rounds, or at least based on the time. So if you think about Series B versus Series C compared to Series B versus Series E, that as you go through the later stage of the funding round, the capital structure gets more complicated, and then the features of Series E funding rounds, for example, should be really different from Series C. So it's kind of almost mechanically making things more different. And authors are aware of this issue, and then for their regressional analysis, they include this round gap, which is exactly what I was talking about here as the control variable. And then also Ayako talked about the primary versus secondary acquisition is also one flavor to this. But I think one key takeaway from the paper should be this 43.5% number. So in order to understand this based on more kind of a nuanced way, I think the authors can consider standardizing this based on this distance between the funding rounds, or if there is some funky names based on the rounds, then maybe authors can use the time or some other measures between the two funding rounds. So bigger suggestion might be this. So the authors, so in order to understand this paper, I recommend that you read the author's a previous review of finance paper, which examines a lot of different flavors of the similar setup. But the authors kind of ruled out the agency-based explanation from their previous paper. And then in this paper, they're more focused on the information-based explanations. And then they use a longer experience of the mutual funds and some other stuff. But I think the key exercise, one thing that they can consider is this. Think about there are two mutual funds here. Fidelity invested in both Series B and Series C rounds of Dropbox. And think about Vanguard only invested for some reason Series B and didn't participate in Series C funding round. But still, Vanguard has to tell or report the Series B share price at the time of Series C, even though they didn't participate unless they sold it. So what I wanted to suggest is that when Fidelity marks Series B at, for example, the price at 43.5% in 2014, what is the Vanguard's valuation? I think this part can add the more direct evidence of the information acquisition channel, meaning that the Vanguard didn't participate in the Series C round, and then Fidelity participated in Series C round. I'm not so sure how many observations you can get for this particular case, but at least if you can try and then see, compare these two, I think that can be more direct evidence of the information channel here. And I think the paper is almost underplaying the broader implication of what they are finding. So in order to do that, I just wanted to briefly start why the authors wanted to study mutual funds. So what about VC funds or what about hedge funds? So VC funds, if you study the same thing for the VC funds, the pros or the positive side is that I think the authors can naturally rebuild or revisit the Barber and Yasuda 2017 JFE paper. By what I mean is that this can be a really natural setting to examine the net asset value management around fundraising. So Barber and Yasuda found that the VC fund might be doing this NAV management around fundraising. So if I was a venture capitalist and I wanted to boost my NAV, then I think the natural setup for me is going this thing, the junior stakes and the senior stake, what about the same price? Or some sort of this more agency flavor here can be possible. So this can be a good extension, but the negative side or why don't bother with the VC funds is that in the end, VC funds are closed-end funds, and then investors are not getting in and out based on NAV. So there isn't much of the wealth transfer or financial fragility issues that the authors talked about. Then what about hedge funds? I think hedge funds can be a really great setting to test this because they may have some larger exposure to private companies in terms of the magnitude. But of course, the authors is going to be really challenging to get the data. So I understand this limitation, but I wanted to push a little bit further what authors can do to give broader implication about their finding. So as Ayako suggested, the authors are trying to extend the sample period to include the market downturns. And then I think the authors can do more about the wealth transfer exercise here. So I wanted to suggest two things. One is the magnitude. So think about, I wanted to read something like this sentence or outcome from their introduction, which is that if a given mutual fund's 1% holding is private startups, X% of the misvaluation might happen, resulting in Y dollar of wealth transfer based on certain cases. And then Z% of it comes from this junior stake misvaluation. So it sounds a lot, but already the authors, based on their previous paper, they already have all these ingredients to do this exercise. And also possibly the authors can use this recent JFE paper, Choi and al. Talking about what happens if the bond mutual funds investing in these stale bonds, and then the stale pricing is going to creating a wealth transfer. And then they did some numerical exercise to show that what is the dollar value of wealth transfer that is happening possibly in this case. So I think if authors can nail and then explain this number, I think that can have a broader implication. And also I wanted to know so-called covariance property especially between financial fragility or even bubble and then wealth transfer that can happen because of this NAV misrepresentation. So think about there's market boom and market bust, and then there's fund flow because because mutual funds are open-ended funds. And then think about, for example, institutional classes and retail classes. And then the authors can do some exercise. What is the direction of the wealth transfer, and what's the severity of the fluctuation in the flow, and then who is winning and who is losing under what market. And I think if the authors can do this exercise, even though they do not have data for hedge fund or any other asset managers, I think the authors can claim that this might be the case for those sectors as well. So just giving the heads up that this can be a really consequential in terms of the overall financial market. Okay, so I think the concluding thoughts are that the authors are asking really important question, and I totally believe what they did, and then this is really thorough exercise. And then I want to say that the authors are kind of the best people in our profession to study the role of non-VC investors in so-called traditional VC market. So I think there are still many unanswered questions. So for example, as Ayako suggested, the literature has so far studied the bull market because that's when these investors started to enter the VC market. But extending the sample period is a great idea to open many doors for what happens when the bull market ended and then the sell-off started. And then the number two is, I think the cyclicality of the VC fundraising and investments, and then how that's gonna interact with open-ended mutual funds style. And then if you can just consider that the cyclicality of the funding market can be better understood. And then the third one is, I thought about this thing, but mutual funds, VC-backed company investments can be used in two tools. So I just did a Factiva or newspaper article search. And then a lot of mutual funds are using these VC investments as marketing tools, meaning that, the VC market is hot and the retail investors are going to be left out, but we wanted to prevent this problem. So we wanted to give this opportunity. So that is one possible scenario. And also the second scenario is that the Ayako has explained that the VCs, based on the IPO expectation, isn't giving too much information about the valuation, how correct the valuations are. But what I found from the newspaper search is that journalists or some people are gauging the IPO market or how likely this firm is going to go public that the mutual fund holds, and then what's going to happen to the IPO market based on how these mutual funds are marketing these shares, and then whether they're acquiring, whether they're selling. Those things can be the reverse source of information for the broader IPO or the VC market. So I found some evidence that these people are actually doing that. So I think if the authors can think about those issues in the future, as I said, I think your team is the best one to answer all these questions surrounding the role of non-traditional investors in the VC market. Okay, that's it. Thank you.